we are back on page 59 of Ink and Grow Rich, same book. This book takes a while to read, especially if you're trying to learn it and soak up the knowledge. So we're still on section 3. We have about 10 pages to go. So application of golden tax secrets to specific business situations. Okay, excuse me. The home-based business of Sheila Gibson. I live in Reno, Nevada, the heart of the Old West, so it's usual for my clients to have horse or dog boarding. I live in Reno, Nevada, the heart of Old West, so it's usual for my clients to have horse or dog boarding, breeding, and or training facilities. In fact, my family's menagerie includes 3 horses, 2 dogs, and 2 cats. The following case study is actually a conglomerate of facts for a number of my clients. I've changed the details to make it a dog grooming and boarding facility owned by a fictitious person, Sheila Gibson. While I've taken a touch of literary license, the facts remain similar to many familiar cases and perhaps even your own. Home is where the money is. My new client, Sheila Gibson, had a talent with animals. Sheila had successfully raised and shown her prize Bedlington Terriers. She was known as a specialist in the special clip necessary for the lively animals. And finally, one day she decided to make the plunge and start her own boarding and grooming facility. First, she converted the garage into a complete grooming facility and set up more kennels on her acre of land. She had many of tools for grooming already, and she formed a corporation for a new venture. Now what? So now we kind of get what's going on. So I'm going to read this quote. Place yourself in the middle of the stream of power and wisdom which flows into your life. Ralph Waldo Emerson. Tools. First, Sheila listed all of the tools that she contributed to her business. These included the tables, clippers, cages, and other such equipment. She then assigned a fair market value based on what she knew they could sell for on the open market. These assets were then sold to the company for promissory note. These assets were then sold to the company for a promissory note. So she then assigned a market value based on what she knew they could sell for on the open market. These assets were then sold to the company for a promissory note, which she can then draw against tax-free, which she can then draw against as her company becomes profitable. Expenses. She kept careful track of her expenses. Cost of incorporation, cost of remodeling, business cards, and the like. Sheila paid some of the expenses before she started her company. The company will pay her back for these expenses and take the deduction. Chart of accounts. After consulting with her CPA, Sheila set up a chart of accounts that best fit her company. She did this on a carefully selected software packet on her new computer, which was deductible. By doing this, she was sure to track all of her deductions. Filing system. She set up a filing system to file her receipts so that she could be sure to keep all of her deductions in case she was audited. Athletic facility expenses. These allow a corporation to deduct the cost of providing athletic equipment for employees. Sheila felt that it was important for her to keep in shape so that she could more safely handle the animals. The corporation authorized the purchase in its minutes, and she could then write off the equipment. Office rent expense. She quickly discovered that she needed to convert a spare bedroom into an office. With that addition, she had 1/3 acre in kennels. With that addition, she had a 1/3 acre in kennels, her double car garage, and a spare bedroom utilized for the business. She then perused the newspapers to determine a comparable rent for the space used by the business. She found that storage on bare land was most comparable to her 1/3 acre in use for kennels. The bare land generally rented for $250 per month. The double car garage was most comparable to warehouse space at 60 cents per square foot. The bare land generally rented for $250 per month. The double car garage was most comparable to warehouse space. Total $288 for 480 square feet. And finally, she found that a gross, including utilities and janitorial lease averaged $1.45 per square foot in her area. totaled $208.80. This all totaled $746.80 per month that the corporation would pay her for use of her home. This would be rental income to her, against which she could expense a pro rata portion of her mortgage interest. This would be rental income to her, against which she could expense a pro rata portion of her mortgage interest, property taxes, homeowners insurance, utilities, janitorial expenses, and depreciation for that portion of her expense. These deductions are rental expenses against rental income on her personal income tax return. Sheila kept good records of her personal expenses for a year-end personal tax return. Telephone. The IRS code in section 262 specifically states that the main telephone line cannot be a business deduction. Sheila added a second line for her business in the name of her corporation. The cost of this line is fully deductible. Sheila was now receiving equipment, meals, and $746.80 per month in rent from her corporation. These benefits are all either at greatly reduced tax rates or completely tax-free. As her company began to make more money, we discussed the benefits of becoming an employee of the company. At some time, practically all owners will have to draw a paycheck from the corporation. Admittedly, it can be a hassle to calculate payroll taxes and make mandatory tax deposits. Sheila learned that it wasn't very hard to do, and that the benefits greatly outweighed the hassles. Admittedly, it can be a hassle to calculate payroll taxes and make mandatory tax deposits. Sheila learned that it wasn't very hard to do, and the benefits greatly outweighed the hassles. Of the many benefits available to employees, my client selected the following. After weighing all the possible alternatives, buying or leasing a car herself or having the corporation buy or lease the car, she determined to buy a van personally and then have the corporation pay her an auto allowance. While it could have been equally beneficial to have the corporation buy the van, it would have been necessary for her to finance the van in her name because the corporation was new and couldn't qualify for credit. Also, the corporation could not take the full Section 179 deduction. This is because she had already hit the limit with all of the new additional grooming equipment: candles and cages, tables, desk, filing cabinet, computer, and printer. Her decision would probably have been different if the corporation had not already hit the Section 179 limit. She estimated her miles at 1,000 per month. The corporation then began paying her an auto allowance of $300 per month. This is not reportable income to her, but she is responsible for tracking mileage and reporting it to the corporation on a steady basis. She pays for the gas and the maintenance for the van because they give her money for it. Achievement Award. During her first year of business, Sheila gave herself an achievement bonus of $400 because she worked so hard. The $400 paid for a luxury weekend for herself away from the family. This was tax-free to her, a deduction for the corporation, and a very welcome break. So the corporation paid Sheila $400. The corporation got a deduction. Education Assistance Plan. Sheila's daughter had just graduated from high school and was interested in pursuing a degree in biology. She went to work for her mother cleaning cages and drew a small salary that helped with her out-of-pocket expenses. The salary was deductible for the corporation, and because of the daughter's low tax rate, ready taxable for the daughter. Sheila set up an education assistance plan that went up to the legal maximum. So Sheila's daughter had just graduated from high school and was interested in pursuing a degree in biology. She went to work for her mother cleaning cages and drew a small salary that helped with their out-of-pocket expenses. The salary was deductible for the corporation, and because of the daughter's low tax rate, ready taxable for the daughter, Sheila set up an education assistance plan that went up to the legal maximum of $5,000 per year for all employees. Her daughter then went to college on the company. Make sure you study Section 4 to look at the benefits and potential traps of employing family members. We're only on Section 2. Group term insurance. My client purchased a low-cost term insurance policy to cover both employees. This valuable benefit was tax-free to the employees and a tax deduction for the corporation. Health insurance. The corporation paid for health, vision, and dental insurance for my client, including full dependent care. The health insurance plan also had disability insurance for my client. Fiscal year-end. One of the real benefits of a corporation is the ability to use a fiscal year-end. Sheila set up her year-end as March 31. She could have selected the end of any month, but the nature of her business lent itself to using this fiscal year-end. Her busiest time generally began about May and ran through the summer. By closing the year out just before her busy time, she would have time to catch up on accounting for her tax planning before her busy time. She has also set up the year-end so that she can bonus herself in March and have full 9 months before her individual year-end. By closing the year out just before her busy time, she would have time to catch up on accounting for her tax planning before her busy time. She also set up the year. She would have time to catch up on accounting for her tax planning. So she's setting up a plan on what she's going to do for a corporation right before it gets busy. She also set up the year end so that she can bonus herself in March. What's bonus herself? She has also set up the year end so that she can bonus herself in March and have a full 9 months before her individual year end. Low corporate tax rate. In February, she had compiled her income and expenses for the first 10 months of the business, and from that determined that she had about $20,000 of income left in her corporation. In February, she had lower corporate tax rate. In February, she had compiled her income and expenses for the first 10 months of the business, and from that determined that she had about $20,000 of income left in her corporation. Since this income was taxable at the lowest corporate rate of 15%, and additional income to her would be taxed at the higher 28%, we decided to not bonus additional money to her. An additional income to her at her individual rate would be taxed at the higher 28%. We decided to not bonus additional money to her. However, she qualified for a pension plan. She contracted her local stockbroker and set up a simplified employee pension SEP plan for a nominal fee. She had to cover all employees who worked more than 1,000 hours in that year. Sheila was the only employee who had worked that much, so she could contribute 15% of her salary. This is the deduction for a company too. Future plans. As the year goes on and her business grows and prospers, she will likely pay more to her children as she brings them into her business. In the second year of business, she will buy more equipment or perhaps a truck for the business in order to make full use of the Section 179 deduction. Sheila will succeed as she prospers. She will also likely investigate methods of asset protection and estate planning. Any of us can experience this kind of exciting future. We just need to begin and take control of it. As you can see, the home-based business as a corporate-run entity has many tax benefits. The storefront business also has advantages if it is incorporated, as the following information will show. Storefront business. First, let's start with the definition of a storefront business. Generally, this term is used to describe a business that has a location other than your home. This is the place where you meet most of your clients or customers. How was a storefront different? The general expenses discussed in the preceding chapters are applicable for your corporation no matter where your business is located. Also, the beneficial deductions available to employees are available to all corporations. Obviously, then a major difference is that a corporation with a storefront cannot usually pay you rent for a location unless, of course, you directly or indirectly own it. Obviously, if it's your own house and you can pay yourself, the corporation can pay you for the rent. Is that a corporation with a storefront cannot usually pay you rent for a location unless you own it, right? Source of income. The second issue to consider is the source of income. This issue is especially important to business owners in high income tax states such as California. If you have a business selling goods that is located in Sacramento, California, it doesn't matter if you have a corporation that was started in another state. You still owe California source tax. Source of income. It doesn't matter if you have a corporation that was started in another state, you still owe California source tax. On the other hand, if you have a business that provides services all over the United States, such as through the internet, you probably do not have California source tax. On the other hand, if you have a business that provides services, you don't have a California source tax. If it provides services all over the U.S., these are complicated issues involving controversial tax strategies that will vary based on your personal circumstances. Make sure you check with your own tax advisor regarding your own special circumstances. Tax traps of the storefront. Besides the issue of source tax discussed above, the deductibility of tenant improvements has continued to be a sore spot for taxpayers. The tax code IRC section 16818 states that you must depreciate tenant improvements made to real property over the same length of time that real property should be depreciated. What does it mean? The tax code IRC section 16818 states that you must depreciate tenant improvements made to real property over the same length of time that real property should be depreciated. This is regardless of how long your lease term is. In other words, if you lease a space for 2 years, you can still only depreciate the improvements over 39 years. If you move out at the end of the 2-year lease, you can write off the rest of the improvements. How to avoid this trap? The definition of capital improvements versus repairs becomes important in this case. Capital improvements versus repairs. A deductible expense is one that maintains property in a normal and efficient condition. Capital expense is one that adds value to a property a capital expense is one that adds value to the property or significantly increases its life. A deductible expense is currently expensed, deducted in the year the expense is made, or the expense is paid. A deductible expense is one that maintains property. A deductible expense is one that maintains property in a normal and efficient condition. It's a repair. A capital expense is one that adds value. It's like an upgrade. A deductible expense is currently expensed, deducted in the year the expense is made. Capital expense must be depreciated over a specific term. In the case of tenant improvements, it's a long time. No, it is not the size of the expenditure that determines if it is expensed or capitalized. Study the following chart for examples of capitalized and deductible expenses. Remember, the key is to make the expenses deductible where possible. Obviously, it will not be possible in all cases. Capital expenses are for improvements that are materially added to the value of the property, prolong the life of the property, adapt the property to a new and unforeseen different use, are incurred for piecemeal fashion. Deductible expenses are improvements that are incurred to keep the property in operating order and do not add to the value, do not prolong the life of the property, are incurred because an event makes an asset worthless, are incurred. Repairs. So deductible expenses. So if you add to it, it shows depreciation because it's going to get old. But deductible expenses are just repairs. Deductible expenses are for improvements that are incurred because an event makes an asset worthless. Because something happened, now the asset is worthless, so you got to make a repair on it. You can get a deductible for that. You get a deductible for repair. Deductible expenses are for improvements that do not prolong the life of the property. Do not make it fix the foundation, you know? Deductible expenses are for improvements that are incurred to keep the property in operating order and do not add to the value of the property. Yeah, because if you own a storefront, you have to pay the owner, right? But you have to make repairs. But that repair, you can get a deductible on it because it's keeping your business going. Like the owner of the building should be the one making those big depreciating changes, you know, improvements. Tenant improvements. So capital expenses, they're depreciating. Like you're spending the money, like you're the owner spending the money. Like And then deductible expenses is what money you get back because it wasn't your money you were using to make those improvements. Tenant improvements. When having repairs done that might be considered as reconditioning or renovation, have the work done at different times and preferably completed in different tax years instead of all at once. In this way, the work may be considered currently deductible. When having repairs done that might be considered as reconditioning or renovation, have the work done at different times, so like little by little, and preferably completed in different tax years instead of all at once. In this way, the work may be considered currently deductible. If you do too much to it, it's going to be considered like a major improvement, Capital expense. All right, well, we have 1, 2, 3, 4. We have 4 more pages. Corporate year-end. Time is everything. Saved by the year-end. One important aspect of tax planning is to take a close look at projected income within your corporate year-end. For a manufacturing client, we looked at projected income. For a manufacturing client, we looked at projected income within the client's 2 corporations before the corporate year-end. The owner's 2 separate corporations were located in 2 different parts of Nevada and produced different items. We had decided earlier to have 2 different fiscal years. Corporation number 1, the older and more stable of the 2, had a year-end of June 30th. And corporation number 2, only in business for 2 years, had a year-end of September 13th. The new manager at corporation number 2 miscounted the inventory by $100,000 in September. We didn't catch it at that time due to lack of historical information with which to compare. Suddenly, corporation number 2 had $100,000 more income than anticipated. Wait. So only in the business for 2 years, the new manager at corporation number 2 miscounted the inventory by $100,000 in September. We didn't catch it at the time due to lack of historical information with which to compare. Suddenly, corporation number 2 had $100,000 more income than anticipated. So he kind of said it. Luckily, there had been a sale of assets. Luckily, there had been an asset. No, luckily, what did you say? Luckily, there had been a sale of assets from corporation number 1 to corporation number 2 just prior to September 30th. We were able to justify a higher sales price than we had originally thought. This reduced the income in corporation number 2 by shuffling it off to corporation number 1. Because corporation number 1 had 9 months until its year end. We had time to plan for it, all with no tax penalty. This demonstrates just one of the many reasons for making use of fiscal year ends for your corporation. So all right, jumping at several small opportunities may get us there more quickly than waiting for one big one to come along. Jumping at several small opportunities may get us there more quickly than waiting for one big one to come along. Hugh Allen. Jumping at several small opportunities may get us there more quickly than waiting for one big one to come along. Hugh Allen. All right, fiscal year end. One of the greatest benefits of a corporation is a fiscal year-end. Use a fiscal year-end, a year-end other than a calendar year-end, to defer tax on payments to you for up to 11 months. By using fiscal year-end, you can stagger payments between corporations to maximize deductions and provide a safety net for tax planning. You'll get better advice if the year-end does not end during your accountant's busiest time. Select a fiscal year-end. Your corporation can have a year-end of any month end date. It is generally easier as a practical matter to have a year-end that is on a quarter end, for example, January, February, March, April, May, June. So March 31st, June 30th, or September 30th. New corporation. If you're setting up your corporation, use Form SS4, Request for Employment Identification Number. Form SS4, request for employment identification number. On Form SS4, fill in the date you have selected, 331, 630, 930, etc. That is now the year end for your corporation. The tax return will be due 2.5 months after the closing date. An extension can increase the due date by 6 months. What to do your taxes. Existing corporation. If you have already selected a calendar end and wish to now change it, you may if the corporation has not changed its accounting period at any time within the 6 calendar years ending with the calendar year that includes the beginning of the short period required to effect the corporation has not changed its accounting period at any time within the 6 calendar years ending with the calendar year that includes the beginning of the short period required to effect the proposed change. The short period required to effect the change is not one in which the corporation has a net operation loss. The taxable income for the short period is, when annualized, at least 80% of the taxable income for the preceding tax year. The corporation is a personal holding company, a foreign personal holding company, an exempt organization, or a non-resident foreign corporation, and has had the same status for both the short period and the preceding tax year. And the corporation does not try to make an S corporation election for the tax year that immediately follows the short period required to effect the change. If you meet these required conditions, file Form 1128 before the due date, including extensions of the short period return. A return is then filed for the short period. Avoid potential corporate traps. Don't make this mistake. It was the first time I had prepared a return for my new corporate client. And like so many others, he had the mistaken idea that all a CPA did was take his numbers and put them on a form. There hadn't been any advanced planning, so what we saw was what we got. I was totally dismayed to discover that my new client, an ophthalmologist, had a C corporation with the calendar year end. I was totally dismayed to discover that my new client, an ophthalmologist, had a C corporation with the calendar year end. He ran the sales of eyeglasses through the same company. The net income from the sale of the eyeglasses was small compared to the bulk of his income. The net income from the sale of eyeglasses was small compared to the bulk of his income. For personal service, this meant his income within the corporation was subject to the higher personal service tax of 34%. The lack of prior planning for my client didn't help him for that year, but we made changes for the next year. First, we created a new corporation for the sale of eyeglasses. Corporation number 2, with a year end of June 30, we had corporation number 2 pick up a pro rata portion of office overhead but little other expense. The pro rata split was based on actual square footage. We then changed the year end corporation. We then changed the year end of corporation number 1 to March 31st and ran the remainder of overhead and the doctor's salary against his corporation. The plan was to minimize income on corporation 1 and allow enough time from March 31st to December 31st to defer taxes if we needed to do a large bonus to the owner. We'd also utilize the lower tax rate for corporations for corporation number 2. We also utilized the lower tax rate for corporations for corporation number 2 by setting up a corporation that was exempt from the personal services tax. Finally, we staggered year ends for future tax planning opportunities. Who says accounting isn't fun? There are 2 corporate traps of which you need to be aware: the personal holding company and the personal service company. A brief description follows. Who says accounting isn't fun? There are 2 corporate traps of which you need to be aware: the personal holding company and the personal service company. Personal holding company. In addition to the regular tax on corporate income, a special 39.6% tax is imposed on the undistributed personal holding company income of a personal holding company. Don't do a personal holding company. Definition: a personal holding company is any corporation in which at least 60% of adjusted ordinary gross income for the tax year is personal holding company income in. Number 1, at least 60% of a personal holding company is any corporation in which 1, at least 60% of adjusted ordinary gross income for the tax year is personal holding company income. And 2, at any time during the last half of the tax year, more than 50% of the value of its outstanding stock is owned directly or indirectly by or for not more than 5 individuals. Personal holding income. No, personal holding company income. Personal holding company income. Personal holding company income consists of dividends, interest, royalties, rents, unless they constitute 50% or more, or the adjusted ordinary gross income in the sum of A, dividends paid during the tax year, B, dividends considered to be paid on the last day of the tax year, amounts received by a corporation from contracts for personal services, including gain from the sale or other disposition, other non-earned income. Why can't they say this in plain words, Adjusted gross income. So you got to watch out for those traps, but personal holding company, personal service company. Adjusted gross income. In determining whether 60% or more of a corporation's adjusted ordinary gross income is personal holding company income, the following adjustments must be made. Rental income must be reduced by depreciation, taxes, interest, and rents. Royalties must be reduced by depreciation, depletion, taxes, interest, and rents. All capital gains are excluded in determining whether the 60% test has been met. This is just a brief encapsulation of the special rules regarding a personal holding company. If you may fall into this area, seek professional tax advice. Personal service company. Definition: a personal service company is a corporation in which the principal activity is the performance of personal services that are substantially performed by employee owners. An employee owner is an employee who owns more than 10% of the outstanding stock of the corporation. Further, a personal service corporation is specifically identified as any corporation, substantially all of the activities of which involve the performance of services in the field of health, law, engineering, architecture, accounting, actuarial science, performing arts, or consulting. The Internal Revenue Code is quite specific in sections 269A and 448 as to the definition of personal service corporations. So what if mine is considered a personal service corporation? The corporate tax rate for a personal service company is a flat 35%. There's no graduation of tax rates such as in a regular corporation. I have one client where the wife is a high-income physician and the husband is a high-paid consultant. In their case, a personal service corporation was a great solution. This was because their marginal tax rate from the wife's income was 39.6%, and with the corporation, the couple could pay 4.6% less tax and get many corporate advantages. However, under most circumstances, most people would want to avoid a personal service corporation designation. How do I avoid this? For many people, such as the ophthalmologist in my example above, there's no way around the personal service corporation designation for a portion of their income. Some people can redefine exactly what the corporation does and hereby change the tax implications. See your tax advisor if you are concerned about this aspect of your corporation. Conclusion. So, personal holding company, personal service company. I don't want to do none of that. Conclusion. Remember, the tax code is constantly changing. Always consult with your accountant to verify that the figures you are using are current and to ensure compliance with any special rules governing each deduction. Use the golden tax secrets given in this chapter as a guide. The federal government and the IRS make it possible. They actually help you to function profitably as an entrepreneur. However, you have to know how to use the tax codes effectively in your business. To gain the maximum benefits from the tax codes, you need to incorporate your business. If you operate a storefront business, you will need to incorporate in your home state. You can use multiple corporate strategies and other entities to help you minimize your taxes. Plan your corporate year-end to your advantage. Be aware of potential corporate tax traps, which include those related to a personal holding company and a personal service company. All right, that was the end of that chapter, man. Or actually, that was the end of section 2, chapter 3.